So welcome to Nailing FX Swing Shots. Hopefully the clue is in the name of the style of trading that we'll be looking at doing, which will be swing trading. Now, to be fair, Forex is a beautiful market. You can basically do anything with it. I think personally that it makes more sense to swing trade Forex, just based on the fact that there are so many orders that move through it. Currencies tend to trend for a while. So to me, it makes more sense to swing trade it, but you can take these concepts that we look at and the methodology that we look at here and apply it to day trading if you'd like, or investing if you'd like. All you need to do is change the time frame, but everything else stays the same. So first things first, we just need to make sure we cover the disclaimers. They should be being highlighted there on the top. There we go. And of course, disclaimers are important for you guys to understand, not just legally, but also to understand that these types of videos are demonstrations. Meaning, we're showing you how we do things. You can ignore it if you want. You can take it on board if you want. You can do anything else in between. It's ultimately up to you what you do with this information. So my name is Becky. I can see there my email address. So becky@tradewithufos.com. If you have questions, you can email me on that. Or I actually prefer that you guys use this link to ask questions, and I'll show you why in a second. So tradewithufos.com/Becky. Let me just bring that up. That's this page here. Now at the top of this page, you can set yourself up with a free Trade with UFOs membership if you don't have one already. And then you can come down and ask a question here. What that means is that the question goes in public and so does the answer. So yes, you can email me, always happy to answer emails and help you guys out. But if you ask the question and get the question answered in public, then it helps other people out as well that might have the same question. So I prefer that you do that. If not, though, you can email me, of course. Okay, so just to come back here for a second, you guys let me know on the chat box. Have you joined me in a session before, or have you joined maybe one of my colleagues in a session before? Trade with UFOs or Tradictive? Let me know in the chat box there if you've joined us before and you understand it. If so, then I'll go a little bit quicker through our trading opportunities. If not, I'll expand a little bit more and explain it a little bit more so you guys know what we're doing and why we're doing it. So for those that may have joined before or been in the last session, let's just take a quick look at, whilst I give you guys time on the chat box there, let's take a quick look at the trades that we put on last time. Now, we put on 2 trades last time, and it actually worked out that both of these trades were losers. But hey, that's what happens in the markets. We manage our risk and we use stop losses just in case we're wrong, right? So in this situation, if I switch this down a little bit so we can see both our targets, we had our entry was this black line, our stop was this red line. We had one target at this green line and one target at this green line. Now, obviously, what happened is we put the trade on round about here, and price came in very quickly, went through the area, meaning it hit our stop. So we lost that trade. Now, not a problem, because we put trades on and risked exactly what we're happy to risk or what we're comfortable to lose per trade. So no problem, it happens. And again, if we didn't have a stop loss, perhaps we would have ended up losing more. So we always use stops. So let's get rid of that one. That was the pound Swiss. And then the Canadian yen, we actually had a similar situation. So put it on both time frames there. We had a similar situation, but let's look at it on the bigger one as well. We had a entry here, a stop loss here, a target here. In fact, if we switch this a little bit, we'll see our second target. So entry on the black line, stop on the red line, target here, target here. Now, price came out very, very nearly hit our first target, which would have been a break-even trade, but just about missed it and then moved through the area. Again, that happens. This is why we use our stop losses. Very unfortunate that we didn't quite hit our target there, but perhaps let's have a look at when, oh no, that would have been, yeah, here we go. So if I highlight this candle and I come down here to the auto climate, if we were actively managing this trade, we perhaps would have cancelled it at around about break even. Now, I'll explain it more as we go. And again, you guys let me know on the chat box if you've experienced our sessions before and you know what our methodology is already. Yes or no, either way is fine. For those that don't know, These dots down here are extremely important. We use these dots, ignore the lines coming out of it for now. We use these dots to tell us what trades to get into. Should we buy or should we sell or should we do nothing? If it's a thick red dot, then we look to sell because it's telling us the probability is down, which is why we place this sell order around about there. But where I'm highlighting, where I have that line, the candle that actually broke through the area, the dot had changed to a blue one, a thick blue one. That would tell us probability upwards. So if probability is upwards and we have a sell order waiting out there, or we have a sell trade waiting out there, the best thing to do is to cancel that trade. So depending on when you saw that, if you did manage the trade actively, this may have been a break even, i.e. bought it back at around the same price that you sold it at. Or if you were just setting and forgetting and you didn't understand about the climate, then it could have been a loss. But hopefully that makes sense as to why it could have been one or the other. Okay, so let's take a look at some new trading opportunities. I know you guys are quiet in the chat box most of the time. I don't know why on FX Street. Most of the time people are quiet. I don't know if that's a good thing or a bad thing, but let me know, guys. The more you let me know what you've already seen, what you already trade, what you want me to look at, the more you can get out of these sessions. So please don't feel shy. Please chat to me in the chat box so I can see what you need and see what you want me to go through. In the meantime, we'll take a quick look at this screen, and because I'm not sure whether you guys have seen this before, I will explain what this screen is and what we see on the screen, what the scan is. Again, if you've already seen it, you let me know and I'll skip past these things. So when we're looking at this kind of screen, we're on TradeStation at the moment, we're using a scanner. You might be thinking, okay, there's loads of different colors and different boxes and different words. What is this about? Now, first things first, we want to look at the ones that have these yellow boxes. And we have these yellow boxes. That is the scanner telling us these are opportunities that are near. You might see the word near. Meaning these are opportunities that are more worth your time to look at because they're closer to now. If we're going to get into a trade or place a trade, we want to place one that's close to where all of the probabilities line up. If it's not close to where the probabilities line up, then we might wait a long time to get into the trade, or things might change by the time it gets in. So we want to be looking at the near opportunities. Now, there's something else to be looking at here. So you might notice some of them say near sensible short or near sensible long, and some of them, it's a fainter font there, but it says near hopeful long. Now, hopefully you guys would agree with me that when we're traders, we don't want to be hopeful. We want to be sensible. We want to be trading something that has more likelihood of going in our favor, not crossing our fingers and saying, oh, it's near, hopefully it'll be fine. We want to be sensible. So if we want to be sensible, we need to look at just those sensible ones. So that reduces what we're looking at. So instead of 3 boxes up there, it's 1. Instead of 5 there, it's 4. Instead of 6 there, it's 2. And of course, we have things on the right-hand side as well. We'll come to that in a minute. Now we filter this down even more. Essentially, we're using this scanner because we don't want to be going and just looking through a checklist or a watch list of different currency pairs that takes us, I don't know, 20 currency pairs. Maybe it takes us half an hour just to go through it. If there's no point, if most of them don't have opportunities there. So we use the scanner to save us time. Now, we've got another element to look at here, which is this column. This column here. You might notice in the column, some of the boxes are red, some of the boxes are blue, some of the boxes are grey. Now, red tells us that there is probability down. Blue tells us probability upwards. Grey tells us not enough probabilities either way. So we want to, of course, eliminate those ones. So if we eliminate those, then we eliminate those 2, and we eliminate the top one. That leaves us across different time frames on majors 1, 2, 3, 4 opportunities to look at out of however many were already there. So hopefully that makes sense as to what we're looking at here. On the right hand side, it's the exact same thing, but these are cross pairs. So what it means is we would be looking at this one and these 2, and we would be looking at these 3 and this one. These are the ones that we're going to be looking at. Again, based on the fact that they're near, they're sensible, and they have a confirmed climate up or down. So with that, Let's take a look at these timeframes first. I'm going to start with the daily climates. Again, you guys let me know if there's a particular currency pair you want me to look at or particular timeframes you want me to look at. Just let me know in the chat box and I'll go do that. For the time being, I'm going to stick to these daily climates. So it means first things first, let's have a look at the dollar yen. That's what we're going to go and take a look at. So we have the 1 day on the left-hand side. This was a daily climate that we just looked at. So we need to keep the daily on the left-hand side, which means we have a 55-minute on the right-hand side. If you're using MetaTrader or something like that, and you can't get a 55-minute chart, a 60-minute should do fine. Just put that to the end. Okay, it was dollar yen, dollar yen. By the way, you might be thinking 55-minute chart is random. Why would you be using that? Basically, they tend to have higher probabilities than the standard timeframes. These are Fibonacci timeframes. But again, it doesn't make too much difference. If you can't get the 55, 60 minutes should be fine. Okay, so let's take a quick look here and see if we have an opportunity. It looks like we do. So let me explain what I mean and how we know this. So I'm just going to squidge this a little bit so we can see both sets of UFOs. So first things first, we have a thick blue dot. That tells us probability is up. We use our AutoClimate app to help us figure out where we have probabilities. And this AutoClimate app is telling us we have probabilities upwards. By the way, the AutoClimate app is a free app, so you can download it. Once you've gone to tradewithufos.com/Becky, get yourself a free membership, then you can download the AutoClimate app for free. And essentially, it comes back with different colored dots. Thick blue dot tells us probability upwards. Thick red dot tells us probability downwards. And thin dots of either color, slightly harder to see, but when they're thin, that tells us not enough probabilities either way, do nothing. So essentially the question of should we buy, sell or do nothing is answered by AutoClimate. So at the moment we are being told we should be looking to buy because it's probability upwards. So great. Now, if we're going to buy, where do we buy? And by where, I mean where in price. Which areas do we buy at? Do we just buy at market, whatever the price happens to be right now? We could do that, but it's based on random subjective, you happen to be there at that particular time. It means that you have less probability of it working, you can't manage your risk very well, and you don't know where you're objectively right. What do you think will happen to US dollar once Fed news releases? Good question. Let me just finish explaining this concept. It will take me a minute or two, and then I will get to that question. Thank you for that. So if we're going to decide where to buy, we need to have something that helps us to do that. And you guys might use moving average crossovers, you might use Fibonacci retracements, you might use patterns, candlestick patterns, you might have a visual technique that you use. For us, we use our auto UFOs, which are these little guys. They look like flying saucers, but they're called UFOs. It stands for unfilled orders, meaning these green areas, it's highlighted here on the right-hand side, the exact prices. These green areas show us where we have buying. If we want to buy where there's lots of other buying. It's much more likely to go up if we have more buyers than sellers. And so if we have lots of buying going on there, it's more likely to have more buyers than sellers. So we want to be in with them. If we were selling, then we have these red UFOs that tell us exactly on the right-hand side as well what the prices are. Those tell us where sell orders are, where selling is. We want to sell where lots of other people are selling. It's much more likely to beat the buyers and push price down. So coming back to that question before we move on with this example. So what do you think will happen to the US dollar once Fed news releases? To be honest, I don't look at the news, nor do I try and interpret it. And I'll tell you why. There might be some people that do very well on that. There are so many examples in my own trading, but also so many people across the world, including the experts, that try to interpret what the news might mean and get it wrong. There have been situations where everyone is absolutely convinced that price is going to go down and it goes up. There's situations where people are absolutely convinced the price is going to go up and it goes down. And that's because news is something that's subjective. So, for example, there was a situation a couple of years ago where there was a bombing at an oil rig in, I think, Saudi Arabia it was. And you'd think that the price of oil would go down because there'd been a bombing at an oil rig. But what happened, let's say this was oil, is it gapped down, hit a big UFO, and then jumped up. So what everybody thought the news was telling us was going to happen was the opposite. Sometimes it's situations where the news is exactly what you think it's going to do, and it goes up from there. There were loads of situations with Brexit. Obviously, Brexit was in the news forever. I'm not sure if you guys, wherever you are in the world, if it was as prominent, but every day there was news on Brexit, and Theresa May was having a meeting with this person, and she was saying this to this, and this person said that, and there was a vote in the Commons about this. And what that meant is that people were speculating based on what was happening with Brexit. Now, there was a situation where Theresa May had a conversation with somebody and had reported that we wouldn't be staying in the single market or something like that. And what that meant was you would think price would go down, but the exact same thing happened. If price moved down a little bit for a few minutes, hit a buy order, a big stack of buy orders, and shot up within seconds. So again, I've tried to keep away from interpreting the news because we call it Sod's Law. In the States, you might call it Murphy's Law. Probably wrong, whichever one I choose to look at. I try and look at more objectively, where do we have these stacks of buy and sell orders that are likely to move price, regardless of what happens in the news. So once the Fed news is released, let's say the US dollar jumps down. Well, if it jumps down and hits a stack of buy orders, it's likely to go up from there. So I'm just going to wait with the buy orders at that point. If it jumps up, so it jumps up and it goes through this stack of sell orders, but it hits this stack of sell orders, well, then it's likely to go down from there. So I'll wait there with my sell orders. So hopefully that makes sense as to why I've explained that in the way that I have, why I look at the news that way. Ultimately, the news may push it up or down. I'm going to be waiting where the buy and sell orders are to catch it, whatever happens, whether it goes up or down. I'm going to catch it as it moves. And I'll try and keep away from speculating on the news because I'm probably wrong with my subjective interpretation. So hopefully that made sense. Let me know on the chat box if it didn't make sense or if you have any further questions on that. So on this example here, we've got the US dollar, Japanese yen. We had a confirmed probability upwards, thick blue dot on our order climate, so probability up. We have UFOs on the right-hand side. These are the ones we're going to use to help us decide where we're going to buy. Now, we actually have overlapping UFOs. We have this darker green one that's overlapped by this lighter green one. That's very, very close to another lighter green one. So what we're probably going to have to do is encompass all of them. So we'll have this kind of area like this. That will be the area that we buy it. So we'll buy at that top line and we'll have a stop loss at that bottom line. So first of all, if we're doing that, let's just draw that again. If we're doing that, there is a third element that we need to make sure lines up. Now, those buy orders are there for whatever reason. Again, it could be news, it could be people waiting on something that they think is going to happen. It could be there were orders that were there before from major institutions and they're left over. There's loads of reasons why there could be buy orders there. What's great is that I don't have to figure out why they're there. I don't have to know the reason. I just need to know that they are there so that I can get it. I always make the analogy here that let's say you're sat next to the cleverest person in school and it's a really important exam and you didn't study and you didn't really understand it, but you're sat next to them and the teacher leaves the room. And you can legit just peer over and look at what they're putting for the answers and copy them. Now, you probably shouldn't do that, but you don't need to know why those answers are right. You just need to know that they're right because that person always gets 100% on the exams, so they're probably right. So here with our UFOs, we don't need to know why they're there. We just need to know that they're there so that we can copy and do the same thing that the UFOs are doing and just buy where they're telling us to buy and sell out if we're wrong for a limited risk. Might be a bad analogy, but I think that makes sense. So the next element we need to make sure lines up is this number here, this blue number. This is our EMA. We use our EMA, exponential moving average, from the bigger time frame to coincide with our UFOs on the smaller time frame. Now, the reason we do that is because buy orders are coming in here amongst these UFOs for whatever reason. Buy orders are coming in for whatever reason here. But also, if the EMA lines up, which in this case it does, the EMA is 109.735. So let's put a different color in there to show you where that is. So the EMA number is here. So what this means is between these two blue lines, we have buy orders coming in for whatever reason. At the green line, if price hits the moving average, loads of people across the world will also buy it, including hedge funds, what they'll use moving averages as well for their entries. So we'll have buy orders coming in from the UFOs and buy orders coming in from the EMA, which means extra buy orders. The more buy orders there are, the more likely they are to push price up. So we want those two things to coincide, and in this example, they do. Which means we're taking this area, and that's the trade we're going to put on. So let me know, guys, if you have any questions as to why, as to why we're putting that trade on, or if you have any questions on what we've gone over. So I know these are Fibonacci retracement lines. I'm not using them as they were intended. I use them just to highlight lines on the chart and use it as a drawing tool. So hopefully that's not too confusing. So our entry price, what I do, by the way, is I'll draw the drawing tool on the chart and then double click it so I can type over the coordinates, so I don't have to fiddle about with it to get it to the lines I want it to. So what we're doing is we're taking the numbers that the UFO gives us to give us the entry price. So the top number there, that top green number, is 109.771. So I'm going to round that up to 109.78, and then I'm going to add a couple of pips to take into account the spread. So that'll be 109.80. That's going to be our top number. That would happen to be the bottom number on the coordinates there, but that's going to be our entry price. Now our stop loss, we're going to take this bottom green number and use that as a reference. So that's 109.443. I'm going to round that down to 109.44, and then I'm going to take away 5 pips, give myself a little bit of wiggle room. So that takes us to 109.39, and that will be our stop loss. So again, we didn't have to think about any of this. This was done for us based on the UFOs. Tells us exactly where those prices are, exactly where those numbers will be. Now again, by the way, just to go back to that question about news, you may decide, you know what, the news is, I don't know which way it's going to go, but I know that it's likely to be volatile. So you could choose to wait until the news has already come out before you place a trade, rather than wait for it. That would be a more conservative thing to do. Because of course, sometimes with news, you can have extreme volatility, and that's not necessarily a good thing if you're on the wrong side of it. So you could choose to wait till the news comes out, see what happens first, and then get into a trade, as opposed to wait for it to come out and be waiting with a trade. So we have these two lines here, our entry and stop. Now we need to figure out, where are we going to take profit? If we're right, where are we going to be making our money? Now, the first one is really, really easy. The first target that we do, we place 2 targets. First target that we place is always 1-to-1 away. And we do that because, so let's just essentially draw the line. We'll work it out properly in a second. So we've got a line here. Let's say, and this is where we will put our second target. Let's say our second target is up here, but our first target is here. Hopefully it makes sense when I say we're much more likely to hit our first target than we are to hit our second target. Way more likely the price comes in and moves out a little bit in our favor, and then perhaps comes against us, than price comes in and goes very much in our favor. So we place these 2 targets to essentially balance out our risk, balance out our probabilities. If price moves up, hits that line, so it'd be the same as it, obviously it's a bigger time frame, does that, and then comes against us and stops us out, that's fine, because we would have made half of our position and then lost half of our position. So we're break even. We didn't win anything, we didn't lose anything. If price goes in, hits our safety target and continues to go up and hits our final target, then great, we've made half of our position here and we've made more of our position there. Great, overall profit. Or we might have a situation where price comes in and just goes straight through, and that can happen sometimes, and then we hit our stop loss and we lose what we were willing to risk in the first place. So there's 3 things that can happen there. We either break even, we profit, or we lose. So if you work that out, we've got a 2/3 chance. It's not exactly really how it works out, but of the 3 things that can happen, 2/3 of them are not losing. So that's why we do it that way. So how are we going to figure out that target? We can do maths on it. I prefer not to. I'm not very good at maths. So all we'll do here is we'll come across the order panel, type in our entry price, which is 109.80, type in our stop loss price, which is 109.39. That tells us that the difference between those two numbers is 41 pips, which means our target should be 41 pips away because it's 1 to 1. So we click take profit and we type in 41. Now, all we need to do at this point, or what I like to do anyway with the drawing tool, is worked out what that price would be, which is 110.21. Just going to draw a line on there, just so it's really easy to come back to, and type in 110.21. So now we have visually on the chart our entry, our stop, and our first target. Great. Just going to move this down here on the left-hand side so we'll see our second target easily as well. Now, then what we can do is deciding what our risk will be, and you guys might risk 20 bucks per trade, 50 bucks per trade, 100 bucks, 1,000 bucks, whatever. You know, you could be risking whatever you want. Normally, it's going to be a small percentage of your account size that you'll risk per trade, maybe 1-2% max. We're going to assume, just for the sake of maths here, that our total risk is $100. And if we're placing 2 targets, which means 2 separate trades, then each of them need to be risking $50. So I'm just going to put in $50 there. That then works out for me exactly what the units are, exactly how many lots I need to be trading in order to be risking $50 on this trade. So once I've done that, I just double check that the numbers are what they need to be, which they are, and then I'll click buy. And you'll see that trade go in. There we go. So now we have confirmation that it's been placed and we have our limits placed on our chart. Now the second target, we're going to come back to our bigger time frame and we're going to use this number here. The reason we do that is because in the context of an upwards climbing, where we have probability upwards, in the context where we have buy orders come in the context where we have an EMA also coming in, perhaps to bring in buy orders, the only thing that can stop that is sell orders. The only thing that can stop the probability upwards and the buying pressure is selling pressure and more of it, which means, thank you, Tracy, which means if price is moving up based on all of these buying pressures coming together, then the only thing that can stop it is sell orders. So we want to get out before a big stack of sell orders. That's why we use the bigger time frame. The bigger the time frame, the bigger the stack of orders. So we want to get out just before that. So this number here, the bottom number is 112.088. Just going to round that down to 112.08. I'm going to draw that on the chart there so it's easy to see. 112.08. That will be our final target. Now, it's reasonably far away, so it's probably more likely that at some point maybe we hit our safety target, and then maybe around here price starts to change direction, change its mind. We may have trailed our stop loss at some points with that. We'll see obviously how it works out. We may not hit our final target. If we do, great, but if we don't, we'll either break even if it does move a little bit in our favor, or perhaps we might take a small profit with a trailing stop. So we'll see then. So same thing, I'm going to put in my entry, my stop loss, it's remembered. And when I click take profit this time, rather than type in the pips, I'm just going to type in the price, which is 112.08. Same thing, I want to risk 50 bucks on this trade. There we go. So double check that the numbers are all right, and you'll see here, by the way, this trade is a 5.56 to 1 for our second target. 5.56 to 1 for half of it, and a 1 to 1 for the other half. It means somewhere in between, if we're right on both, we're going to get about a 3 to 1 trade overall here. So have a look at buying. Now, just speaking very briefly, so we've seen that go in there. We spoke very briefly about we might have a trailing stop or something in between. Make sure the UFOs are on there. So what that means is, let's move this right across here. Let's say price comes in, hits our safety target, great, everything's great. Let's say price moves up and a UFO forms. And there we go, UFO forms. Well, if a buy UFO forms, price moves up a little bit, then isn't it fair to say that our stop losses down here might do well to be up here now? Because we've got buy orders confirming our trade. If price were to move through these buy orders, then likelihood is the climate's changing anyway. We should probably get out of that trade anyway. So we can use a trailing stop to lock in profits on our way out. Now the downside to that, if we put this over onto the bigger time frame, The downside to that is that we might see price go in our favor, hits our safety target. We have a UFO that's appeared, great. We move our stop loss to here, great. So it may be that if price moves down like that, great, we get stopped out at this point and we actually make a little profit. Or it may be that price gets stopped out a little bit and then goes up and hits our target. And we got out at this point instead of this point. Pros and cons to either way. The trailing stop is a more conservative way of doing it because you're locking in profits sort of more tightly as you go. Leaving it is a less conservative way of doing it because you're essentially saying, I'm either going to win or lose, nothing in between. Either way is fine. It's up to you based on how you feel about probability and how you feel about would I rather win more often at a smaller number or would I rather win less often at a bigger number? That's ultimately up to you to decide that. So that's one trade that we've just put in here, dollar, Japanese yen. We will see how that goes. The next session that we have, we'll see what happened with this one. So we still have time to check on a new trade to see what else we could be putting on. So we just put on the dollar yen here. And because we just put on that one, because we are swing trading, I'm going to come over here to the daily climates for our crosspairs and have a look at more crosspairs here. So we have Aussie yen is that first one that we should be looking at. That's what we have here. Aussie yen, it's near sensible and it's got a red box there. So we'll look at that. Aussie yen. Staying with the same time frames, daily on the left, 55 on the right. Unless you guys tell me in the chat box that you want me to look at something else, in which case we can do that, no problem. Now, in this particular situation, it's actually just become an unconfirmed climate. That's a thin dot, so we'll move on. I know that was very quick, but this is why we use technology, to make it a quick decision. Should we be looking at it? Should we not? If it doesn't line up or we don't see it line up, we don't do it. So this one here is pound Aussie. So let's have a look at the pound Aussie. And it may be, by the way, the first one that we looked at, we had an opportunity. Sometimes we look at charts for a while and we can't find any opportunity. And that happens, right? We want to make sure that we're only trading when we have probabilities lining up. So in this one here, yes, we have a thick blue dot, probability upwards. Yes, we have UFOs, but our closest UFO is here, but the EMA value is here, which means they're not lining up, which means we don't trade it. Then we have to be strict on our rules. If we're going to have rules, we should follow them. Pound yen, that's the next one to look at here. If we can't find any on these time frames, then we'll drop to the lower time frames as well, see if we have any opportunities then. So we have, yes, this one is an opportunity. So great, let's place this one. It looks like we had a trade on here from a while back, so let's delete those things. Okay, so I say that. We did have an opportunity with the UFOs and the EMA, but as we see here, it's just become an unconfirmed climate again. We don't want to be trading unconfirmed climates. So although it might be frustrating that we say, the EMA is here, it's within our UFO, we have three different elements. We have the climate, the UFO, and the EMA. All three of them need to be telling us the same thing. If all three of them aren't, then we don't do it. Now, you may be somebody that just trades what the UFOs are. You may be somebody that just trades at the EMA value, up or down. You may be somebody that just uses the auto climate. No problem. Ultimately, it's your strategy. You can do what you want with it. For us, we need all three of those elements. Otherwise, we're not placing a trade. So we'll move on from that one. What we'll do now is we'll look at smaller timeframes and see what opportunities we have. Now, for our 240-minute climates, we actually don't have any opportunities here. Even though we have near opportunities, and even though they say sensible, all of them are grey, which means all of them have unconfirmed climates. So we don't want to be looking at those. If we come over to this side, we have Aussie New Zealand. So let's take a look at the Aussie New Zealand, see what we have here. So this is a 240-minute now, Aussie New Zealand, which means our smaller time frame is going to be 21 minutes. Again, if you don't have 21-minute chart, a 20-minute would be fine. This is just the Fibonacci equivalent. Again, it might be that we're looking at different data here from TradeStation to TradingView. We again have an unconfirmed climate here. We don't want to be trading an unconfirmed climate, so we'll just move on. So we had Aussie New Zealand, now we're going to look at Euro Swiss. Sometimes it happens because the data that we're using here, I believe, is Oanda data. Oh no, it's FXEM data. Perhaps the trade station is using data from Oanda or a different broker, which means sometimes we get a different outcome, or slightly different outcome than what we were expecting from the scan. Same things happened here. We have an unconfirmed climate, so we move on, no problem there. So we've actually exhausted our opportunities on the 240-minute chart here. So what we'll do is move on to the 60-minute chart. We'll go to the dollar Canadian, which is what we have there as our last attempt to see if we can place a trade today. Dollar Canadian on a 60-minute chart and see what we have. So US dollar Canadian, 60 minutes, which means this is going to be 8 minutes. And oh, I'm looking at the wrong dollar Canadian. There we go. And we do have an opportunity. Now, there may be a slight issue here, and I'll explain it as we go. So we have a confirmed probability upwards climate, great. We have our EMA is 1.2182, so literally just within this UFO, and we have a bunch of UFOs here. So great. You might be saying, what's the problem? This is all lining up. The problem may be, and we'll see, is that these UFOs, yeah, what we're going to have to do is combine all of these UFOs because they're too close together. The reason I say that is because if you just took this UFO and you had a stop loss here, for example, well then as price comes down, you might be selling out just as more buy orders come in. So you'd get out too early. If you put a stop loss underneath this one, again, price might come down. So you've got to give the stop loss a little bit of wiggle room, which means that stop loss would actually fall probably within this UFO. Price would come down. You might get stopped out here, and it's just about to hit another stack of buy orders. So we want our stop loss to be comfortably outside buy orders, like in this white space here, where we wouldn't be stopped out too early. Now the problem here may be, and what we'll do is we'll use our Fibonacci tools here just to see. So yeah, put that back on. There we go. We'll use our Fibonacci tools here just to see what those numbers will be. So if I just cover that there, before we even look at what those numbers are exactly, we have a slight issue now. Look how big that area is relative to the room available. So if we were buying, then we want to make sure that we sell as a target at this stack of sell orders. So that means our buy orders are here. That's our risk, essentially. And our reward would be this. We don't want an inverse risk to reward correlation. We don't want to be risking, I'm just going to make up the number there, risking $50 to make 10. I'd rather risk 10 to make 50. If we're going to risk so much to make such a small amount, it means we have to be right very, very often, which is hard to do in markets that are obviously so volatile and move for many different reasons. I'd rather be right, 40–50% of the time, but when I'm right, I make a lot more than what I lose when I'm wrong, so that consistently builds up to make me money, rather than risk a lot to make a little, and perhaps that goes against me, and I'd only need to be wrong once or twice, and I'd have to be right 10 times in a row then to make money. So hopefully that makes sense. So although we have these things lining up, the risk to reward ratio here is not good enough for me anyway to be placing this trade. You guys might, but for me, it's not something that I would do. So we are coming to the end. I don't know why the study keeps coming off there. We're coming to the end of the session. So let's just go back to the trade that we put on. I can't actually remember which trade it was. It was it dollar yen? So let's just summarize really quickly the trade that we put on. Yep, there we go, dollar yen. We had it on a daily chart, 55. Great. So this was the trade that we put on today. We have buy orders that we placed our trades with. Buy orders here coincided with our EMA value, which is why we placed that trade in the context of a confirmed upwards climate. So probability up, and probability up. That's why we place that trade. We have a safety target that's 1 to 1 away. So if price moves a little bit in our favor and then goes against us, we have a break-even trade. We have a final target that's further away, so that if price went further, we'd make more money. So overall, that's the trade that we placed. Hopefully you understand the methodology start to finish there, why we placed that trade, how we placed that trade. We do these sessions, a lot of my colleagues do these sessions as well. We all follow pretty much the same methodology. The thing about trading, just to close here, that I want to make the point on, is that it really is okay to do different things than other people. I always compare it to a franchise business. Take McDonald's. It's the biggest franchise in the world, I believe, or one of the biggest franchises in the world. A McDonald's in a mall in Texas works differently to a McDonald's in an industrial estate in Vietnam. They do different things, same company, but they have to apply it in a different way because their environment is different, their subjective reality is different. So they take a model that works, but they mold that model to fit their circumstance. That to me is what trading should be. You have a model, which could be our methodology, could be other methodologies that you've learned. It's okay if you tweak it to fit you. If you have different risk tolerance, different amount of money, different time that you're available, different way that you think about things, then you might be somebody that says, I'm just going to take the one-to-ones all the time and not even try and take those final targets, because I'd have to be wrong more often, because it's way more likely the price goes somewhere towards it and comes against us than goes all the way there. And I'd rather just be right more consistently. So you just take one-to-ones all the time. You could be somebody that says, no, I'm not putting that trade on, I'm not putting that safety target on. I'm going to have just the final target. Because if it goes there, I'm going to make a lot more money than if I take half the position off early. That's going to reduce my profit. Both of those are extremely valid way of looking at the markets. So take a methodology, back test it, demo trade it, tweak it if you need to fit what makes more sense to you, and that will mean that you do it more consistently. If you change your methodology all the time because you're following somebody but it doesn't quite suit you, so you follow somebody else and that doesn't quite suit you, and you follow somebody else and you get a few winners and then a few losses, you're not consistent, which means your results are inconsistent. Better to either take on board that methodology and do it 100%, whichever one it is, and model it exactly, or tweak it to something that makes more sense for you so that you're more likely to do it regularly. So that would be my advice to you guys. So hopefully today was helpful. Hopefully it made sense. We have a trade that we've put on, so hopefully we'll see that goes in our favor, but we will see next time. Any questions? You've got my email address is becky@tradewithufos.com, or you can go to tradewithufos.com/Becky, get yourself a free Trade with UFOs membership there, and then you can ask questions here in a public space, or if you want, you can book one-to-one coaching with me if you want to do that. Otherwise, guys, I'll be back next time. Hopefully you found this useful, and I will see you in a couple of weeks. Take care, guys, and happy trading. I just saw that question come in there. What makes major changes in currency pairs from being strong and becoming weak? We are meant to be closing the session. I think FX Street will close it very, very shortly. So if you want to email me, becky@tradewithufos.com, I'll put it on the chat box. I will answer that question, or go to tradewithufos.com/Becky, get yourself a free membership and then ask me there so I can answer it publicly. Sorry, I don't have the time to do it now. Sometimes we run out of time, but hopefully you've got that information there that you can use to get hold of me, and I can answer that question for you. All right, take care, guys. Bye-bye.